Imagine going out to your mailbox on an ordinary afternoon, sorting through grocery flyers and utility bills, when you notice an official envelope from the IRS. Surprised, your stomach tightens. You open it, expecting some routine notice. Instead, you're staring at a $10,000 penalty. And the worst part? You genuinely have no idea what you did wrong. You didn't hide money overseas. You didn't run a secret business. You didn't lie on your tax return. All you did was deposit some cash from selling your truck, or your daughter sent you money to help with medical bills, or you moved funds around so you could finally replace that old roof. Size: completely normal retirement activity. But in 2026, normal doesn't always mean safe, because what's triggering these penalties isn't classic criminal behavior. It's patterns. Patterns flagged by automated systems that don't know your story, only your numbers. And once the system decides something looks suspicious, penalties can start at $10,000 for a single issue. Today, we're going to break down exactly what's changed, why so many retirees are being blindsided, and the one simple mistake that can turn a harmless visit to the bank into a federal problem. Hi, I'm Artur, and I spend my time helping retirees protect the nest egg they spent a lifetime building. There's something that has quietly shifted in the financial world this year. The underlying rule we're talking about has existed for decades. What's new in 2026 is the enforcement. Faster, automated, and much less forgiving when the data doesn't match up perfectly. My goal isn't to frighten you. It's to help you clearly understand what's really happening, what kinds of everyday banking activity can trigger a major penalty, and most importantly, how to protect yourself so you never see that $10,000 surprise. Because once you see how the system actually works now, you'll realize the danger isn't obvious, and that's exactly why we need to talk about it. Let's start with the everyday transactions that feel completely harmless. You sell your old pickup for $15,000 in cash, the buyer counts it out, you drive to the bank and deposit the money. Straightforward. Or your son wires you $20,000 so you can cover unexpected medical bills. Or you finally take that lump sum pension payout you've been putting off. Or you shift a large amount from savings into another account because you're putting a down payment on an RV. None of that is illegal. None of it is shady. It's just life and retirement. It's your money being managed responsibly. But here's what's changed in 2026. Banks are no longer just passively processing deposits. Certain types of transactions are reported automatically. And those reports don't go into a file drawer. They go straight into automated systems designed to look for inconsistencies. So when a big chunk of cash appears in your account, the system doesn't see truck sale, help from my daughter, or pension payout. It just sees a number, a date, and an account. Then it compares that information to your tax returns, Social Security records, pension distributions, and other financial data. If the pattern it sees doesn't line up with what you've reported elsewhere, it raises a digital eyebrow. This is the part that feels deeply unfair to many retirees. From your point of view, you're just handling your finances. From the system's point of view, it's asking one very specific question. Where did this money come from, and was it properly reported? If that answer isn't crystal clear in the data it can see, the trouble can begin. Here's the twist that surprises almost everyone. The rule behind this is not new at all. It's been on the books for decades. What changed is how aggressively and how efficiently it's being enforced. The heart of this is something called a Currency Transaction Report, or CTR. The name sounds intimidating, but the idea is simple. By law, banks must file a CTR anytime someone makes a cash transaction over $10,000. That includes cash deposits, cash withdrawals, and some types of cash transfers. So if you walk into your bank and deposit $12,000 in cash, the bank completes a CTR and sends it electronically to the government. You don't fill it out, you may not even know it happened. It's done in the background. And here's what's crucial. A CTR is not a fine. It's not an accusation. It's not proof you did anything wrong. Millions of CTRs are filed every year. For a long time, this has been totally routine. Business owners deposit cash, people sell cars, Families move money. The bank files the report. Life goes on. So, if that's been the rule for years, why are retirees suddenly hearing about $10,000 penalties? Because in the past, most of these reports just sat in databases unless a human investigator had a reason to take a closer look. Today, that's no longer how it works. Now, CTRs are fed directly into automated systems that immediately compare them to your tax returns, Social Security records, pension data, and other financial information. The system isn't just collecting information anymore, it's analyzing it in real time. When it finds something that doesn't line up, like large cash deposits that don't seem to match your reported income or activity, that's when trouble can begin. There's also another layer that's even more dangerous than simply making a large deposit, and it's where many well-meaning people inadvertently cross a line. They think they're being careful, but in the eyes of the IRS, one decision can turn a fully legal transaction into a violation. That decision has to do with how you structure your deposits. Here's where everything changes, and where many honest retirees accidentally step into risky territory. Let's say you have $12,000 in cash. Maybe it's from selling a boat. Maybe it's savings you kept at home. Maybe it's money you've had for years and just never put in the bank. You walk in ready to deposit it. Right before you reach the teller, you think, if I deposit all of this at once, they'll report it. I don't want to draw attention. I'll just deposit some now and the rest later. So you put in $8,000 on Monday, then come back on Wednesday with the remaining $4,000. From where you sit, that feels harmless, maybe even wise. You're not hiding income. You're not trying to evade taxes. You just don't want extra government paperwork. That seems reasonable. But under federal law, that choice fundamentally changes how the situation is viewed. What you've just done is called structuring. Structuring is when someone deliberately breaks up a large cash transaction into smaller pieces for the purpose of avoiding that $10,000 reporting requirement. The part that catches people off guard is this: the money itself does not have to be illegal. It doesn't matter if it came from your pension, the sale of personal property, or a family gift. If the deposits are split specifically to avoid triggering a CTR, that action alone can be treated as a federal violation. And penalties for structuring commonly start around $10,000 per violation. Let's put this side by side because this difference is critical. If you walk into the bank and deposit $12,000 in cash in a single transaction, the bank files a CTR. That's it. It's routine, lawful, and in most cases, nothing more happens. But if you intentionally deposit $8,000 and then $4,000 specifically to dodge that report, you've just created exactly the kind of pattern automated systems are tuned to detect. Those systems look at timing, amounts, and the sequence of transactions over days or weeks. If it looks like your deposits were structured to stay under the threshold, red flags escalate quickly. And here's the uncomfortable truth: the system can't read your mind. It doesn't know that you didn't want attention, but had no bad intent. It only sees the pattern. And in this context, the pattern is what matters. That's how so many good, careful people get into trouble. They think they're being cautious, that they're staying under some invisible radar. In reality, breaking up deposits to avoid reporting is the very thing that puts them squarely on the radar. So let me say this as plainly as I can. Having a currency transaction report filed on your deposit is not a problem. Trying to avoid that report can be. That's the shift in 2026. With advanced automation, cross-referencing, and real-time data analysis, these patterns don't quietly slip through the system anymore. The software doesn't need a human investigator at a desk. It flags inconsistencies automatically, compares deposits to your tax returns, and looks at your cash activity versus reported income. When the pieces don't fit, letters and notices go out. Before you let this turn into full-blown anxiety, pause for a moment. The IRS is not trying to punish retirees who are simply managing ordinary, well-documented finances. The vast majority of people who handle deposits correctly, even very large ones, never face an issue. The real danger comes from misunderstanding how the rules work. So here's the first big rule of thumb. Never split a transaction just to stay under $10,000. If you have more than $10,000 in legitimate cash, deposit it as one transaction. Let the bank file the CTR. That is what the system expects, and that is what keeps your pattern clean. If this explanation is already making things clearer, take a moment to like the video and subscribe. I share updates like this specifically to help retirees avoid expensive mistakes before they happen, not after. Now that you understand structuring, we need to talk about the next piece: how to protect yourself going forward so that even in this fully automated IRS environment, you're never stuck scrambling to justify your own money. Now that we've identified where the real risk lies, let's move from awareness to protection. This isn't about panic. It's about practical preparation. Yes, enforcement in 2026 is more automated, faster, and less tolerant of discrepancies. But the steps you need to take to protect yourself are surprisingly simple. You don't need fancy legal tricks or complicated strategies. You need organization, clarity, and a solid paper trail. First and most important, document everything. Anytime a large sum of money moves in or out of your accounts, keep clear records showing where it came from and why. If you sell your car for $15,000, keep a signed bill of sale. Make a copy, scan it, and store it safely. If your daughter gives you $20,000 to help with medical costs, have her write a short gift letter stating the amount and that it's a gift, not income, and not a loan. If you take a lump sum pension payout, keep all the distribution paperwork. If you withdraw cash to pay for a large purchase or a contractor, hang on to the invoices and receipts. The goal is simple. If anyone ever asks, you can immediately show both the source and the purpose of the money. Most retirees don't realize this, but the IRS's systems don't automatically know the story behind each transaction. They see numbers, dates, and amounts. Your documentation supplies the story behind those numbers. When that story is clear and backed by paperwork, questions tend to be resolved far more quickly and with far less stress. Second, if your finances are more complex than just Social Security and a modest pension, now is a smart time to talk with a qualified tax professional. A good CPA doesn't just plug numbers into a form. They help ensure your tax return actually matches what's happening in your bank accounts. If you had a big deposit after selling property, that needs to align with what's on your return. If you received a sizable gift, they can help make sure it's recognized and documented the right way. Automated enforcement flags mismatches. A tax professional helps prevent those mismatches from existing in the first place. Third, be open with your bank. This one catches people off guard. There is nothing wrong with asking your bank how they handle reports on large cash deposits. In fact, being straightforward can help. If you know you'll be depositing a large amount of legitimate cash, you can simply walk in, deposit it in full, and let the bank file the CTR. Remember, the CTR is normal. It's not an accusation. Trying to get around it is what creates problems. When you combine these three habits, good documentation, professional guidance when needed, and transparency with your bank, you dramatically lower your chances of ever encountering that $10,000 surprise. Let's pause and look at the bigger picture. The automated systems running in 2026 are powerful. They link deposits to tax filings. They look for patterns humans might miss. But at the end of the day, they are still data-driven tools. They run on consistency. When your records are organized, your tax return reflects your reality, and your money movements make sense on paper, you're operating exactly where the system expects you to be. This isn't about hiding from the system. It's about giving it nothing to question. If you know another retiree, a friend, neighbor, or family member, who still believes that keeping everything under $10,000 is a smart way to avoid attention, share this with them. That old advice can easily cost someone $10,000 or more in the current environment. Because here's what you really need to understand. The enforcement shift we're seeing in 2026 isn't temporary. It's not a short-term pilot program. It's the new normal. Automation is now woven into how financial oversight works. The systems are faster, more interconnected, and they run constantly in the background. That means the retirees most at risk are not the ones doing something clearly criminal. They're the ones still operating under outdated assumptions. For years, people believed that if nothing seemed to alarm the bank teller, it probably wasn't a big deal. Keep deposits small, stay off the radar, handle things quietly. You were being cautious. In today's world, that thinking can produce the exact opposite result. Trying to stay under the radar is what creates the radar signature. One clean $15,000 deposit with documentation, routine, logged, processed, usually forgotten, multiple smaller deposits, intentionally timed and sized to avoid reporting, pattern detected, flag triggered, questions generated. The system isn't emotional. It doesn't automatically assume guilt, but it does assume that patterns designed to evade reporting deserve a closer look. And once that closer look begins, the process can be stressful, slow, and costly to resolve. I also want to ground this in some reassurance. Most retirees watching this will never face a structuring penalty. Most large deposits, when handled properly and backed by clear records, move through the system without incident. The point of this isn't to make you nervous every time you walk into a bank. The point is to replace uncertainty with clarity, because clarity changes how you act. When you understand that a currency transaction report is normal, you stop fearing it. When you understand that structuring is about intentionally avoiding that report, you stop accidentally creating risky patterns. When you understand that documentation tells your financial story, you start naturally keeping the records that protect you. This is really about a shift in mindset. The old mindset was, keep it quiet. The new mindset has to be, keep it documented. That one change can save you enormous stress. So here's the question I want you to think about seriously. If a fully digital IRS system reviewed your last 12 months of financial activity, would your story make sense on paper? Would every large deposit have a clear, documented explanation? Would each major movement of funds line up with what's on your tax return? If the answer is yes, you're right where you should be. If the answer is, I'm not sure, then now is the ideal time to get organized. File and scan your paperwork, consult a tax professional if needed, and clean up anything that feels vague. Not because you're in trouble, but because preparation is always far less expensive and far less stressful than penalties. You spent decades building your retirement savings. You sacrificed, planned, and made careful choices so you could enjoy this chapter of life with stability and peace of mind. The last thing you want is a preventable $10,000 penalty born out of a misunderstanding about how bank reporting works today. The rules themselves haven't radically changed. What has changed is the speed, visibility, and automation behind enforcement. The retirees who do best in this environment aren't the ones who panic. They're the ones who adjust. So deposit large, legitimate amounts properly. Never break up cash deposits just to stay under $10,000. Keep documentation for major financial events. Make sure your tax return reflects your real money movements. And treat transparency as protection, not exposure. When your financial paper trail is clear, organized, and consistent, the automated systems have nothing to challenge. And that's where real peace of mind lives.